Calvert Smith Accountants in the middle of York, and my job today is to try not to bore you and talk to you for about 20 minutes on some of the taxation issues surrounding the ownership and letting of residential property. Some of it you will be familiar with, no doubt, but there are some changes, and we would just like to go over the implications that may arise from those changes. So over the next 15-20 minutes, we're going to touch on a number of topics. Can everybody see the screen? I feel like I'm stood in the way. We're going to look at just straight residential buy-to-lets, the furnished holiday letting rules. We will touch on, under those topics, the income tax, capital gains tax and inheritance tax considerations. We'll have a brief look at company structures and incorporation, and then at the very end, just a brief word on trusts and how they may help with capital gains tax liabilities. Before we start on those areas, I think it's worth just touching base on one of the issues that arises across the board when you're looking at property activity. And what's often posed is whether some cost that a client is incurring actually represent capital or revenue expense. The difference here is that anything that constitutes capital is relevant to the capital gains tax regime, and therefore it adds essentially to your acquisition cost for the purpose of that tax. Essentially, therefore, the tax relief is delayed until you get a sale or transfer of the property. And so obviously a lot of cash flow with no tax relief at the outset needs to be factored into cash flow. By contrast, anything that we can put under the revenue heading is most likely going to receive an income tax relief. So that, again, is relevant to where the taxation liabilities rise. There's some areas listed on the screen there. I think some are quite clear what constitutes what area of cost. The original property purchase and related costs, and that would include legal fees, stamp duty, land tax, etc. on the purchase. Well, they're quite clearly the capital cost at the outset that form part of the capital gains tax base cost. Perhaps a more contentious area at times is whether then subsequent costs you incur represent improvement to the property or whether they are bona fide repair cost. It's often a subject of discussion, if I'm honest, with differing views often between the revenue and what the client perceives to be the case. But I think a useful rule of thumb to have is that a repair cost would constitute making good what was there before without necessarily adding some new functionality to the property. Whereas if you're adding functionality, you probably crossing a line for improvement. So, for example, if you add a bathroom or a conservatory or do something of that nature, clearly you're adding to the capital base cost in those circumstances. An area to watch when you're going into property letting or adding to your property portfolio is where you may acquire a property and then undertake a refurbishment before you actually let it for the first time. HMRC's view in that area is that as you've acquired a property at a lower value because of the state of the property at the time of acquisition, that the costs incurred getting it ready for letting are capital in nature. So it really needs to be factored into your initial outlay, and I would discount any prospect of immediate tax relief on those sort of costs. You'd be waiting again until a sale further down the line. Another area to watch, which perhaps isn't a question of capital or revenue, but more whether you're going to get any tax relief at all, is where you start to incur costs, whether that's actually repairs or any other cost, in relation to a property where you've decided to no longer let the property. So once that decision is made not to re-let, then the revenue do not allow costs associated with that property. So you typically see that when you're pulling a property out of the letting business and selling it. Costs you see going through might be council tax, utility bills, repairs, and making it good for sale. And those costs will be restricted in a lot of cases. Also, they may not add to your capital gains tax base costs because they don't actually represent capital costs. So you end up in a no man's land with no tax relief on anything that you're spending. So it's just something to be aware of, and timing can be quite critical if you're thinking of pulling the property out of the business as to when you might undertake some of the remedial work. I know it's not always easy with a tenant in situ, but just bear that in mind. The replacement basis, that's on there, it's a relatively new concept. Some of you may have had furnished letting activity in the past and been familiar with something called wear and tear allowance. That has gone, that's fallen by the wayside, and what came in 2016 was something called replacement basis. And this doesn't apply to furnished holiday lets, but applies to either furnished or unfurnished letting activity. And the principle is that the first time you acquire something like furniture, furnishings, appliances, carpets, all those sort of items. The first time you buy them for a property, it's capital, so no tax relief. But thereafter, every time you renew that item, you get 100% deduction for income tax. So at the very outset, you can again have costs that you're not going to get relief for. But as time goes on, it arguably, especially for the unfurnished letting activity, is more generous in that you can get that replacement value off your tax bill when you're replacing a fridge or a washing machine or something of that nature. Final concept on that slide is HMRC's take on whether you're replacing something with a modern day equivalent. So some of you may have let property for a number of years and you decide that you need to substantially upgrade the property, and those costs can be significant. Where you've got something like, for example, a property has single glazed window units and you decide to replace them, it's quite accepted now that to put in a double glazed unit is just a like-for-like modern day replacement of the windows. You'll get relief as a repair cost, even though arguably the double glazed units are better in a number of ways than the single glazed. Another example would be the replacement of lead pipes with plastic pipes or something of that nature. So they do accept that things have moved on, you may use different materials, and to that extent, provided you can argue that to be the case, when you're undertaking those big projects, you will get a repair deduction against income tax instead of needing to wait until capital gains tax kicks in at the end. So that's just some principles behind how we account for the letting income.